Welcome back to another episode of Key Factors Podcast. I'm your host, Mark Jones, and we are sponsored by ReviewMyMortgage.com, the largest index of mortgage programs nationally. And this episode, guys, I want to kick off this new season with some guests that I've had on a previous episode that, in my opinion, are the experts in San Antonio's market, including luxury real estate and the who's and what's of what's actually taking place. So without further ado, I want to welcome my guests. We have Stephanie Paxton and Robert Elder. Guys, how you doing?
Wonderful.
Good. Thanks
Wonderful.
for having us back.
Yeah,
Absolutely. So there's plenty content for us to talk about. But I want to start with giving you guys the stage for a moment to just tell us who you are. If those of you have not seen the previous episode that we have recorded, please go back and take a look at that. But I don't know, just a real quick who you are, what you guys do,
Ladies
and
first.
we'll take it from there.
I feel like I should have a new tagline. My name is Stephanie Paxton, and I'm obsessed with real estate because it's true. It's become an obsession, and it's been so fun recently because it's all in the news and that's what everyone's talking about.
I agree.
Definitely all in the news.
It's so true. It's so true. And that's something that I do want to get to talking about here shortly. But Robert, go ahead.
Yeah. So 31 years in the business. Stephanie and I run a team of 4 now. We added another buyer's agent. And then, of course, we have our back-end staff as well. But several thousand transactions and over $650 million in
Millions
sales.
of sales.
We might kind of know what we're doing.
I love that. And when talking and having these kind of conversations, I think it's important for those that are listening to know that they're listening to somebody that is an expert, because there's a lot of people out there that can, what I call, fake the funk. They can go through the motions, they can regurgitate different videos that are out there, but there's very select few that actually do the research and can apply it to what they do on a regular basis. You guys are the prime example of that, in my opinion. So kicking this off, in our first topic, I want to dive right into what the hell is going on with our market.
Lots of exciting stuff. It's definitely a diverse market, wouldn't you say, Steph?
I think it's a confusing market.
That's a great way to put it.
That is a good word.
Yeah. I think it's very confused. I've always believed that buyers catch on to the market quickly. It takes a while for sellers to get it. And then once sellers start to they either get out of the game and get off the market, or they get right with the price and get the house sold.
It seems like with sellers, it takes several months, maybe 3-4 months for them to really understand, oh, this is the new market we're in. We're still seeing several that are in the old market,
sure.
mindset-wise, exactly. So they have these expectations of all these things that their friends might have experienced, but that ain't that ship sailed. It's sunk, as a matter of fact.
So what do you, that leads me to a question. What are you guys doing when you do have the unrealistic seller? And I'm sure there's a lot of folks out there that are going to have this experience or are having this experience. Is they go to a listing appointment. The seller says, I believe my home is worth $400,000. Realistically, it's probably worth $320,000, and they won't take anything less. What do you guys do in that situation?
So I think during our listing consultation, we hear what they're trying to say. And you learn really quickly who are real sellers and who aren't. And there are times where I've had people that are not necessarily real sellers. However, there's a chance because they have a unique property and somebody might pay that. However, you usually see that on the higher end. When you have just like a cookie cutter, property or something that's like in a typical neighborhood, the writing's on the wall. It's pretty clear.
Pretty cut and dry.
Data. Yeah. At the end of it's just data. She's great at data. She's a data geek. I'm not the data one, but it's like you put it in front of them and it's like facts are facts. It just is. At this point, facts are facts. What would you agree? 8 months ago, facts were not facts. I mean, you could have the data in front of you and then you'd get some wacko. It's like, okay, I'll pay $100,000 more.
Yep.
Okay.
And that hurt us.
Right.
There was a period of time where our experience hurt us.
Sure.
Because we were like, there's no way the house is going to sell for that. I remember vividly, I had a gentleman that had a ranch. He had this crazy easement to his ranch. And I was like, there is no way anyone is going to pay what you want for this house.
And it had been on the market several times.
Several times for much less. Right. And he had a number. And I was like, I can't list it. I don't want to spend the marketing money, and I don't want to tell you every week I can't sell your house. Someone else listed it, and it sold in a week. And I was like, my experience hurt me. Yeah. And this person, I guess I could call them survivalist type of property, because that's really what it was. Perfect environment for that house to sell. Perfect.
Yeah.
And we missed it.
And I mean, you've got that, but then at the same time, you've got this thing that most buyers actually need, which is lending. You need the lending side of things. And we still have, and it's not a trend. It's just every once in a while, you'll find a home that does not appraise for what it actually sold for. Mm-hmm. And somehow, some way, it's this huge surprise to everybody. It's like, guys, oh my goodness. Did anybody run the comps? Seller, did you got the comps to send me? No. Buyer, how about you? No. So you're saying you just allowed them to put this offer because that's what it was listed for and that's what they were willing to pay. Right. And I think that is the coolest part about our industry or market is it still has to appraise unless you've got the cash to put over and above. Right. In our market, San Antonio, in my opinion, is not the kind of market that you've got people with excess cash. Austin.
Not local.
Not local, correct.
Not local.
Austin, different story. They've got... easy come, easy go kind of mindset. A lot of techies that are making plenty of money and they want what they want and can get what they want, right? If that makes sense.
Right.
So I don't know if that's skewing the market or what that's doing to it.
Well, we definitely saw a lot of those people coming in from other markets, with truckloads of cash from, what they sold. So I really think, like Stephanie said, that hurt our market.
Sure.
I mean, it really, really did. It just made it very different.
Yeah.
And like she said, we lost several. We definitely easily lost over 150,000 in income.
Yeah.
Because, we know what we know from experience, but it just at that time didn't help us.
Right.
But now the funny thing is now we're going back to the experience because the market has changed.
And that's I think, an awesome thing about this shift that we're seeing. Because in my opinion, we're not seeing a crash, nothing close to a crash.
Not even remotely.
But not even remotely. But yet all you see is literally crash, crash, crash.
We are seeing a crash.
Okay. Explain.
But it's in transactions,
not
number
price.
Of
transactions.
Okay.
The
Explain
amount,
that.
So when you look at the number of sales, they have gone down dramatically.
What is it? 30%? Is that the number?
I think nationally, it depends. Locally, I haven't done the numbers in our local market. But yes, I think nationally it's been 30%, which is a huge number.
Yeah.
And those are lenders that don't have a loan.
Correct.
Those are realtors that don't have a commission. That's
Correct.
Title company. So that affects
a lot.
The overall.
As a whole.
Yeah. So,
and you've got this confusing thing that you take a shrink in transactions, this ridiculous market that we just experienced and are coming out of, parlayed with a lack of inventory still.
Yeah, still
and
a lack
for
of
years
inventory.
to come.
Right.
For years to come.
So the definition of a switch in the market from a buyer's market or a seller's market to a buyer's market has a lot to do with inventory. Once it gets to about 6 months in inventory, that is now a buyer's market. There's too much inventory for the amount of demand that we have on the buyer side.
Correct.
We're at 1.2 months of inventory.
And to your point, this is why I think it's the best time to buy.
I agree.
Because there are so many fearful people out there that are confused.
Yep.
This data is going to catch up.
Yes, ma'am.
And people are going to know. But right now, they don't know. So if they put their house on the market and they don't get an offer, they're willing to deal.
Absolutely.
Big time.
Absolutely.
I mean, they will take $50,000 off their house like that because one, A, they didn't earn the equity. It just happened overnight, basically. And two, they got to make a decision quickly. And so that motivated seller right now, I mean, this to me, if I was a buyer, I would not be waiting for a crash. I would not be waiting for rates.
Right. It's not going to happen.
Right.
And the Fed isn't going to U-turn anytime soon. We can talk about that if you want to. But this is the time to buy.
So there is an article that I stumbled upon, and I believe, JC, if you can click the next tab that it's on. Yeah, go up there, click that tab, scroll down just a tad if you can, because I want to read this quote that's directly from it. Keep going. You'll see the quote. There it is. And the quote is, go down just a tad. The quote is, "We don't have a bubble. We just have an unhealthy home price growth. And I thought that was a damn good quote.
It is. And that's a very truthful.
Right. That came from one of the analysts for Housing Wire, which then goes on to talk about just what you said a moment ago. They're anticipating another growth in our market. Now, we can't speak for all the markets that are out there. Just real estate is always local, and this has and pertains to just our market. It's literally saying exactly what you're talking about because of the bent up buyers that are there, the amount or lack of inventory that we're seeing, and the people that are confused. So at a certain point, they're going to get off of that confused fence, jump into the market, and for 12 months, and it says about 8 to 12 months, you're going to see growth again in our values.
Yes.
Because those homes that are 1.2 months of inventory are going to shrink again unless we get more to the market.
That's right.
And I think the fourth quarter is going to really say a lot because seasonally we're at the end of the buyers out there looking. So sellers at this point, I think they're going to be like, we're just going to stay. We're going to keep our low interest rate and stay where we are. Why are we going to trade it for a 7% rate, which I think is around the corner? And they're going to just stay put. And then the sellers that have to sell are going to sell. Right. And they're going to have to take deals because buyers are still not, they're trained now already to
You're exactly right.
There's so much. This is the funny thing. We're in a period that no one has ever experienced.
Yes, uncharted territory.
Exactly,
for sure.
It's uncharted territory.
Sure.
So where all of these people are coming in and saying, "Well, this is going to happen. This is going to happen. This is going to happen." No, BS. No one really knows what's going to happen. But simple economics, supply and demand. What we know is supply is scarce. What we know is there's still a demand. And like Stephanie just said, when someone needs to buy, sell, move out, move in, whatever, they're just going to do it. They have to. It is what it is. They are not going to wait. Well, I'm going to wait for rates to go down. I'm going to take the job in San Antonio, Texas and leave El Paso or wherever it is.
Right.
But I'm going to wait till rates. No, they just have to buy.
Right.
Suck it up, buttercup.
And I believe it's not a bad decision either because those folks that are doing that already know what they've gained when they sell their home. They're homeowners. They understand that by renting, you're going to pay expenses regardless, but you get none of that back.
Right.
And rental rates are up here right now. So this morning I was listening to one of the podcasts that she turned me on to, Bigger Pockets.
I love it.
I
love it. They're pretty
now I know
educated.
why she geeks out on it.
Absolutely.
There's really good data on there. And during the time from when rates have gone up, there's still been roughly almost a 12% increase in home prices.
Right. It talks about that in this actual article too. I mean, it's the data for some odd reason is, and I can't say it's being suppressed because it's out there, but it's being foreshadowed by this gloom of crash. You look up in YouTube, and I did it before we jumped on here, housing market data. And it's very little things to do with housing market data. But if you look up crash 2022, everybody and their mother has a video about it. Isn't that strange?
It is. Well,
it's like fear sells.
Fear sells.
You know?
What do they say about the tabloids? Was it blood cells?
Oh yeah.
There's a saying about
sex,
that.
Blood, and what is it? Tragedy?
Yeah,
it's true.
It's the stuff that it gets attention.
Right.
Yeah, and then I think honestly, people, she is really good at this, and I've learned this watching her. So she really dives into the data. Most people are lazy.
Yes.
In my opinion.
Yes.
They'll listen to just a minute and okay, that's it. They know everything about it. And they're going to sit there and comment on it.
Mm-hmm. And I think that is going to be a testament as to who can withstand this market, truly. I think that as rates continue to rise, I mean, we're already sitting back up at 6%. That the national average is, I think, 5.99 as of today. Does that mean you can't buy a house? No, that means that you should probably get in sooner so that you have a basis point that is going to yield you some equity down the road versus getting in when the craze happens again. It's just one of those things that I can't stand talking about the media, but it's happening. We're being painted this picture, and the consumers that are digesting it are the same consumers that we have to go and re-educate.
Right.
We have to convince. We've got to prove ourselves.
Exactly.
We've got to bring the data and explain it from another standpoint versus taking these touch points. And I love to see these videos where you've got crash, and in the comments, it's nothing but, I can't wait for the crash. It's going to happen. And I'm like,
the comments are ridiculous.
I would welcome one because I'm an investor as well.
Sure, likewise, yes.
And it just means more properties for us to buy, but it's just not going to happen. I mean, here's what we know. We know we're 65,000 homes short here in San Antonio. We know that builders are pulling back. There's fewer starts. There's fewer permits being pulled because they're confused as well. And also, not that they're confused, but they're not.
It doesn't make logical sense financially to continue to build, not knowing if there's going to be a need for it.
Or what's the Fed's going to do? Everyone's waiting to see what the Fed's going to do, because if that price goes up one more point and everyone has to adjust 10%, where are their costs coming from? Sure. So they're not going to just go put out a bunch of, frames.
Now, I do want to preface with the fact that the Fed raises rates is not a direct correlation with interest rates, with mortgage rates. It's more inflation that actually is tied to mortgage rates. But we, as mortgage lenders, investors, we pre-plan. We want to predict as much as we can. So if the Fed is raising rates or anticipating to raise rates, then we're going to do it before they do so that there's not a big surprise when it happens. So in my opinion, yes, they're probably going to raise rates, but our rates nationally are already on that trend. Now, if they come back and raise it again, we're probably going to raise before they raise. And that's just as a whole. And the idea behind that is the Fed is the one that the investors are getting their money from. The investors then loan the money to the banks and the mortgage bankers. So they've got to make a premium too. For too long, we've had free money going around, in my opinion. Yeah, it was super cheap. And I think that's one of the issues we're seeing with these startup companies is they had tons of money at inexpensive rates, damn near zero. And now you're coming to find that they're not able to pay their bills because their plan, their concept isn't profitable yet still. So if you've got low rates, how can it be profitable with higher rates?
So there's a gentleman that I've, been following for decades at this point, having done real estate as long as I have. And it's Dr. Mark Dodser. He used to be the chief economist at the Texas A&M real estate division. And Stephanie and I are having this conversation. So he spoke via Zoom at our Keller Williams office not too long ago. And he was talking about rates in Q4 going down to like 2. Mm-hmm. And I'm thinking, oh yeah, while some people would say, oh my gosh, that's great. No, I mean, I that actually scared me.
Likewise.
Did I fully believe it? It was hard almost not to believe it because this gentleman he's the man. He's the guru. He's the guy behind the curtain. I mean, he's typically never been wrong. I hope to God it doesn't go to that because, being that we have such little inventory as it is, it would create another feeding frenzy. 100%. And then at that point, honestly, I think the wheels would
super inflated prices, everything. And then when you have an adjustment to that, how do you adjust from that?
Exactly.
We already just are doing it now.
Right.
And people don't believe that those are the true values. They're going to come down. It's like, guys, we're in Texas. But yeah, that's tough.
Yeah.
And in my opinion, you've got to understand that buying a home at a 5%, 6% interest rate is still a fantastic rate.
It is.
Are we going to get back to the 3s? Probably so eventually. Everything's cyclical. And once we got down there, it's now the new kind of break-even threshold for our industry on the finance side of things. So it's absolutely possible. Is it likely? I don't think so. Unless we get inflation under control in a big way. Like I said, interest rates, mortgage-wise, coincide with that inflation wheel. You'll see as inflation rises, as do interest rates to combat that. But that's a good point. I mean, shit, what happens if that happens?
Yeah.
Then,
I think all hell would break loose.
Then you've got a bunch of realtors, lenders jumping back in the industry to help people that aren't there.
Well, and then you look at the long-term over a decade, how it would take a decade to recover from something like that. I think that's the worst thing they can do. I think the best thing they can do is what they're doing right now.
Yeah.
And let's just stay here.
Yep.
6-7%. You can drive a car for 7 years now on a 7% note.
Yeah, that's true.
I mean, most people don't live in their houses that long.
That's so true.
But yet they'll drive a depreciating asset.
Yeah.
Or they'll
Immediately,
pay,
yep.
or they'll pay stupid amounts on their credit card.
Credit, yeah.
22% on
You're
their
exactly
credit card.
right.
It's like, oh my gosh.
Yeah.
I mean, when we had this happen, starting probably mid 2020, after we got through the beginning of the pandemic, people still had to buy homes, all that good stuff, and they started seeing values rise. So they started paying over.
Right.
Well, the same thing was happening in the auto industry, but we're talking a silly amount over in compared to the actual asset of it.
There you go.
So you look at that, and now we're seeing tons of auto foreclosures or auto repos. Why? Because when times are tough, you're going to pay your mortgage. You may not pay that overpriced car.
Right.
So, I mean, I talked to a lot of folks in the auto industry, and they're saying it's starting to slow down.
Right.
They're still having inventory issues as well, but at the same time, they're having a ton of foreclosures come back, or not for repos come back.
Yeah.
But I don't see that in our industry.
When
You go get an auto loan, how much of your income do they verify? How much of your assets? Any of that
I
stuff?
don't know. I just bought one the other day, and I had to send in my 21 or 20 and 21.
So
Good. Really?
and that's very rare.
I was actually happy.
It's probably
It is
an
rare.
expensive purchase.
It was.
That's why.
Yeah.
Okay. So your average person goes into the dealership.
Right.
They buy their $30,000 to $40,000 vehicle, and it's credit score and who you work for on the application.
Yep,
as long as the
exactly.
credit score checks out,
Yeah,
you're getting
good.
a car today.
Yep. Yeah.
You know?
You're right. I was actually glad that they did that.
Likewise, yes.
To do that, because it goes back to how you guys are doing your job.
Yep.
I remember back in 2006, I think it was. I mean, it was like, does Mr. Elder have a sign of life coming from his nose, a little breath? Okay, yeah, give him the loan.
Give him the loan.
There's $1 million. Go for it. Go buy a house.
I agree.
I applaud lenders having to go through diligent processes of making sure that people have the verifiable assets, income, and everything else, because it sets you up that, they can actually buy the home that they're
100%.
buying it. And odds are they're probably not going to default.
Right.
God forbid something catastrophic happens. That's understandable.
Right.
But, they were just freely giving money out back in those days. It is just not the same environment right now.
I agree. So let me address that part in the grand scheme of lending and the crash, and those kind of go together. The previous crash, and everybody keeps comparing it to 2005, 2008 situation. We had tons of foreclosure. We had tons of fraud. We had things that today's market does not have.
No.
I mean, you still have people that are issuing approvals without documents, but in the end, if they don't qualify, they can't get that loan.
Exactly. They're not going to get the loan.
Correct.
Yeah.
And us doing the diligence on our side, one, it builds our level of expertise and knowing exactly what you're doing and what you can offer the customer. But I think the most important piece is you're not seeing the foreclosures. Wonder why.
Well, and you have to also consider that for a year they couldn't foreclose.
Yeah.
So any kind of increase was 100% because there were.
That is number 3 then to what my list is, because essentially, if you couldn't foreclose, that's fine, but it also gave or opened the door for this forbearance program that they're going to keep access to. Meaning, if you fall on tough times like you were talking about, you can access your forbearance that they've already shown has worked to keep people in their homes and paying for their homes, because a lot of these forbearance, when it came due, they actually started paying their mortgage again.
Yeah.
And that was like, wow, we're waiting for it to start ticking up, and it hasn't yet.
Right.
I mean, we're still at historically low foreclosure rates.
Historic lows.
Isn't that crazy?
Yeah.
So,
But then why are the people waving the flag? Foreclosures, short sales.
it's a marketing ploy.
There you go.
I'm saying it now. So if you're out there toting foreclosures on the market, send them to me. I mean, Jesus. Well, I can't find them.
But that's the thing is most people have so much equity, they could just sell it. Why would they even let the house go?
So that being said, and that's a great point, how does that make any sense that if we just experienced, even if you purchased your home in 2020, we just experienced 18 and 19% year over year growth.
You made money.
Equaling 30 some odd percent in equity. How are you going to let that go?
Exactly.
That's not even something somebody can do easily, if that makes sense. Like, even if you wanted to let it go, it doesn't make sense to do that. So, I mean, we've got a lot of things that I can't say it was due to our government or anything like that, but we put in place that can mitigate the amount of foreclosures that are hitting the market. We've got a lot of historic data in place to tell us that at least San Antonio, we're going to be all right for a little while. In addition to not only being all right, we're still going to keep growing, at least in the next 12 months or so, based on what I'm researching.
I think the next 6 years, and to see the money getting put into the airport, I think it's going to bring more businesses, more opportunity here. So I think San Antonio is a great place to live, a great place to invest in long term.
And then as soon as they put some kind of monorail fast track from here to Austin, it's over.
I mean, look at how many people purchased here that were working in Austin. Could you imagine the opportunity that would open up having a system, a transportation system like that?
That would, absolutely.
The possibilities would be literally almost endless.
And I consider Austin like the new Silicon Valley. And everybody's saying there's a crash there that's going to occur. Well, no, there's a correction because things have to slow down eventually. If you keep on rising like it's doing, especially in a short period of time, everybody hurts from something like that. It's just not feasible, affordable, it's sustainable. Yeah. There's so many things that it's like, okay, how can this continue? It can't. So it's time for that to start getting back to reality. And what is the reality? It's just a new reality.
Well, and Austin is turned into, like you said, a Silicon Valley. It is a California. It's a New York. It's not, it's its own like state inside of a city. So it's not, you can't really, we get overflow from that, but it's not the same. Their crash might be more of a crash.
Yeah.
Or
considered a crash.
Considered a crash, meaning their home values may come down more than ours here because we didn't go up as.
So since you mentioned the crash thing again, it triggered something else. No, that's not a bad thing. It's not a bad thing. We're free flowing. So the fact that we went up 2 years, total to 2 years, to about 32, 38% in home value. If there was a price reduction, a value reduction, is it really a crash?
Right. Yeah. Right.
In the end, because we're used to 4 to 6% year over year consistent growth. And that's like since the beginning of time, or at least when they started tracking it, 1972. How is that considered a crash? Now, less fortunate people that intended to sell their home for a profit may miss out, but it still doesn't mean you lost.
You lost, exactly.
You still have the property. You're still in Texas. It's still going to continue. In worst case scenario, we'll get back to 4 to 6%. Bummer with your already 32%.
There you go.
You get what I'm saying?
Yeah, no, totally. I'm tracking what you're saying.
The only thing that I think Texas needs to get a hold of is our taxes.
Oh, yeah.
Because
property tax for sure.
That can definitely make people move, because as their values continue to go up and their taxes go up with it, even at a low interest rate, they're paying more. And so, yeah, that is definitely what I'm concerned about.
And I think that there's a lot of folks out there, and I'm going to give this message to buyers, to homeowners, to realtors that don't know. Texas has a 10% cap year over year on your homestead. So if the value rises by more than that, they're only going to tax you on the increase of 10% moving forward and forward to the next year. So it's a lot of folks are saying, oh my God, they're going to be surprised with all these taxes that they're going to have to pay up front. It will be an increase of 10% if it is your homestead. Now, if you didn't claim your homestead, if you didn't do the research to know that that's what you needed to do in order to, I guess, keep yourself restricted to potentially overextending because of the taxes, that's shame on you. Shame on you, realtor, for not knowing that. Shame on you, buyer, for not doing your research or asking that, especially in a market like this. But if you're listening, watching this, you know it.
Now you know.
Now you know. No excuses. Right. So that being said, I mean, I think we got a good amount of what's going on in our market. You can only repeat so many times before you either get it or you don't. But one thing that I do want to discuss is what you guys think is going to happen with real estate, realtors, lenders, and the lending market as we proceed in regards to it's tougher. It's tougher to obtain customers. It's tougher to keep customers. It is tougher to sell right now. And I say sell because that's what we're having to do. Whereas before, just throw it against the wall. There's so many that, right. So what are your thoughts on that, guys? What does the future say about what's happening in our market and what it will lead to for your average realtor, your average lender?
I think there's going to be, my personal opinion. I've lived through a crash.
Sure.
I look at it this way. I see opportunity. That's my mindset.
Yeah.
I see massive opportunity. I know that there's going to be a massive cleansing as well of LOs, of processors, of, people in the title business. The strong will survive, the weak will not. I doubled my business back in the 2008 time, and I never went back to those pre-2008 numbers. So when all of this adjustment started happening for me personally, I honestly started getting excited. You need to have the professionals in the game. There needs to be the professional loan officers that know what they're doing. I don't see a downside in it. I mean, yes, the downside for the person that has to get out of the industry, but if you weren't making it when there was basically free money, you're not going to make it right now, or it's going to be very difficult. I don't know. What are your thoughts?
I mean, I would definitely say the same. I will say that, because we make up such a big part of the GDP, I think that there's going to be new products coming out to keep stimulate. They have to keep things moving. Right. This is a temporary situation.
Now, when you say keep things moving, can you elaborate on that? Because a lot of folks, and I can't say a lot of folks, but there's some folks out there that really don't understand that concept. Mm-hmm. Keep things moving. What do you mean? What's moving?
So if money isn't flowing, then a lot of people are in trouble. We're going to be in for a depression. This is, so that's one nice thing about the lending side. You guys keep creating things like ARMs, for instance.
That give people opportunities.
And, we talk about dating the rate. Like, yeah, you might not like the rate you're getting in today. However, the beautiful thing about real estate is you can always renegotiate the deal. And so in 5 years, or it could be less, when that rate changes, if you can afford it now, you're in a great position.
Right. So
I think for realtors and for lenders, I think this is the time for the skill to shine. If you, know your market, know your industry, and it's time, get boots on the ground and work. I mean, it's just like you said, the free money is over.
Right. And to sum up what she's saying there is our economy is built and backed by real estate.
It is.
Truly. I mean, any way you look at it.
So much, so many jobs.
Yeah.
Real estate does.
Because the crash prior to this had to do with real estate. I mean, the stock market, things of that nature are all intertwined with mortgage-backed securities. There's no ifs, ands, or buts about that. And I don't know if folks take that seriously, especially the ones that are actually in our industry, So if you were someone that was giving advice to one of these realtors or lenders, and I can come from the lender side, whichever, but what would you give in way of advice? Like, let's say, what are your top 5 things that someone can do to stay relevant and to stay in this business while this is taking place? And who knows how long it's going to last like this, right?
I think I'm going to steal this from Tom Ferry. He says, no, be the knowledge broker. Okay. You have to know your numbers. You have to know what you're talking about. You need to be able to guide people and, hear them, listen to them, and see what makes sense for them. And I literally advised a client to not sell a house. I'm a realtor. That's what I do. I told her, when she told me her rate and their situation, I was like, you cannot let go of that asset. I was like, this is something that's going to help feed your kids and give you lots of stuff in the future. So it's truly coming from value and whomever you're in front of, educating them.
And I think that's going to be the tough part, and have already witnessed this thus far, is if you're a realtor lender not getting business that you need to make ends meet, etc., is it in your best interest to give the right advice? Meaning you may not be in the situation to sell this. You may not be the best thing for you looking at the big picture, but are you going to be able to, as a lender, as a realtor, be honest with knowing that you will lose out on a commission by giving this advice?
Right. We've seen it time and time again where we're starting to now get listings that someone overpromised, underdelivered, because we call them COVID agents. You know, they kind of, in essence, got into business during COVID when anyone could sell anything, and they don't have that skill set. They don't know how to have that conversations. They have zero experience on the back end to deal with a shifting market or really a more normalized market.
Sure.
And we're seeing stuff, you know, where people will call, okay, well, sorry I didn't hire you the first time, but we're hiring you now.
Yeah.
And it's like, okay, well, this is the process. Here's the roadmap to accomplish your real estate goals. And guess what? We get them to the finish line.
Yeah. Because they've got that realistic expectation that you probably have already given them day one, which is why they didn't go with you.
Correct.
They went with the feel good. They went with this dream, not reality.
Right.
You guys were painting reality, and now they're coming back to reality. You know?
Yeah.
So yeah, that's a tough thing. What else? What other things? I mean, you guys went to Tom Ferry. What was that like?
Oh, that was fun.
It was really
rally,
good.
huh?
Yeah.
Really good.
I tagged along.
That's
I was
awesome.
her plus one.
yeah.
No, I mean, and I think that pretty much every market that spoke, that was the beauty of that event, was we got to meet and hear people from all different markets: Arizona, California, Florida, some of the hot markets, and they're all seeing the things change. And that was basically a big part of the whole conference. Was this is opportunity, guys. This is to skill up and go out there and help people.
This is the interesting thing, and I would never dare name this person by name. So people that have been through a changing or a market that has changed, I think, see things through different optics. So recently, a very successful agent in the city was very negative when we started talking about what's going on right now. And on the flip side, it's like I was very excited, and I had to really think about it. And later on that weekend, it hit me, and I told Stephanie, I was like, oh, this is why that person was so negative. They've not experienced. They just know one market, this craziness. And this is someone that's very, very successful. And I said, okay. I mean, I figured out they just haven't been through it. They have no basis to see it from a different perspective.
Well, I'll give you an example that comes to mind at the moment, and it's more of a hypothetical, and I don't like doing hypothetical, but I'll paint you this picture. If you, as a lender, have built your entire business and your career on down payment assistance, bond loans, and zero down programs, well, you probably have a ton of people in your pipeline waiting to find homes. So therefore, can you survive on people waiting for that one house to pop up that's in their price range that qualifies for this bond program, to be able to cash in your paycheck? Or do you have to broaden your horizon, learn new programs, start offering a different segment of what the whole has to offer? Like you're talking about, we've got plenty of programs out there. But if your demographic is the one that can't qualify for anything over $200 and some odd $1,000, you're going to be waiting for a little while. Or you have to be able to say the hard news, which is you may need to move on the outskirts of San Antonio, which there's nothing wrong with that.
Right.
You look at LA and any other city that has grown outwards.
Right.
That's how it happened.
Yep.
USDA is around for a reason, 100% financing right on the outskirts for a reason.
For a reason.
So I have a question for you, because this is something that I find so perplexing when you look at a home and the equity, and it's everyone's biggest investment, but yet they don't have a relationship with a lender that says, hey, Mark, I'm thinking about buying a house. I might be a year out. What do I need to do today? And what options should I be looking for? Is there going to be a 40-year mortgage? Is there an ARM that you would recommend I have? Is there a down payment assistance program? Something that you could tell them, like, this is the best plan for you. Like, we go to financial advisors, we talk about how to retire, but homeownership is getting more complicated by the year. And you should be the first phone call.
I agree 100% wholeheartedly. I'm also going to dissect your question a little bit, because you're right. Most people will call their financial advisor first, when your financial advisor, doesn't know shit about real estate. Unfortunately, they know what they've purchased and what they've seen in larger real estate holdings that their customers have had. But when it comes to real estate advice, you need to go to your lender, you need to go to your realtor, and hopefully the realtor is directing you back to the lender, because everything, it's like a thumbprint. Everybody's got one and they're all different. There's plenty of options out there. It's all about what your scenario is. You can't give broad advice on a hypothetical. And I can't stand when I hear a customer come to us and say, well, this lender offered us this, this, and this. Okay, and what was your credit at when they pulled? Oh, they didn't pull my credit.
Oh, there you go.
Well, what are we talking about here? Like, how does that make any kind of relevant sense? Let's actually pull your credit. Get me your documents. Let's jump on a Zoom call so that I can share my screen and show you exactly what your options are, articulate how they work, what the benefits are, and how to take that leverage in the equity that you currently have.
As it pertains to you.
To you. Is your goal to build a portfolio? Is your goal to just get out of this one to the next one? I mean, I think the answer to your question is, number one, getting them 100% to an expert lender. And then on the lending side, it's truly asking more questions with the right data in front of you. There's no other way. I mean, I have been a lender for quite some time. I say, and I believe that I'm pretty damn good when it comes to figuring out scenarios. But I can't give you some hypothetical based on a blanket statement. There is no one size fit all. Is there scenarios to where we can't offer them something? Plenty. But in those cases, you still show them what they need to do in order to achieve their goal.
And how much does that cost them?
It costs them nothing.
Exactly.
Nothing. It costs you a credit pool, which today you do not get dinged more than 1 to 2 points, and they're temporary and they go back to your credit score. If you're concerned with a point or two on your credit report, chances are you don't have good credit. I'm going to be honest. And even still, my goal is to show you how to raise that score. So it takes you 2 points temporarily to show you how to raise it 50 to 100 points.
Right. There you go.
What's the
it's
outcome?
Nothing but upside.
It's all upside.
It's all upside.
But I don't know why people are afraid to do that, or why they believe they need to go to the financial advisor first. It drives me insane when I see financial advisor. Well, my financial advisor said this. You do realize that your financial advisor gets paid on how much you have on holding with them, right? So they're never going to tell you to take money out to go and buy a property. They're never going to tell you to take money out to do probably what you need to do with that money. It's always, well, let's move this around to a more aggressive fund, or let's move this around to a less aggressive fund. That's the solutions.
Right. Unless you're talking to my financial advisor, he's like, you're always outperforming me. Just keep buying real estate.
Just keep buying real estate.
I think that's my point. And
he actually told her that.
I believe that.
He's like, you're doing better than me. Go buy another house.
Yes. And there's so many scenarios that I think for years, and even when I was doing investments and whatnot for Chase, I would refer to my financial advisor thinking that he had all the answers. They didn't. As I grew in the industry, come to find out, they know about stocks, mutual funds. Most of them can't tell you what the market's going to do, because they wouldn't be doing what they're doing if they did. They'd be playing the market and building their actual portfolio, not gambling with your money.
Do you?
Sorry.
It's true.
I'm with you on that, because I'm going to go so far as to say that, Joe Blow Public, on the real estate side at least, they see equals. This kid just got their license, let's just say this morning. Sure. And Robert, Elder, or Stephanie, they've been in the business and thousands of transactions. To the consumer, they're both licensed. Yeah. That's it. They're, in their minds, they're equals. Same thing with you. You are a guy that'll figure stuff out inside out and sideways, and have done thousands of transactions, and you can dissect that and get that customer the best deal. But then there's an LO that just got licensed. I guarantee in the consumer's mind, they're the same. And it's the same thing with a money manager as well. I mean, there's someone years ago that this guy literally could not pay his car and his mortgage or his rent or anything else. And then one day he calls me up all excited and he's like, hey man, I got my Series 7. I'm going to do, and I'm just like, the fuck, you're touching my money.
Exactly.
But going back,
Truth be told, and before you do, truth be told, I was licensed with my Series 7, 63, all of those licenses. Once I got them, I'm like, wait a minute, you want me to sell mutual funds? Like, what? I'm not really doing what this license is for.
Right.
But I had to study and take the test, get licensed, accoladed. And then it was like, man, all right, so it's kind of a facade.
There you
to
go.
say that you can pass a test. Everything else after the fact is on you.
but going back to you're free to get this information.
I'm available. I'm not free. I'm very expensive.
Available. But I'm sure they have someone that they could talk to that would give them like a plan of action. And you're buying your biggest asset ever that's going to house you, raise your kids, hopefully, grow equity to where you can leverage that however you want. I just don't understand. Like, I drive around, I notice things. I see apartments going up everywhere. The apartments, these investors, these big companies, BlackRock buying up all these properties, they know what's coming.
And I believe that they know because they're creating it.
Truly. True. But it's like, is being a homeowner going to be a luxury item?
Man, that's a good question.
And if so, you need to get on top of it now.
Absolutely.
I don't know why, Mark, I have this thing in my gut right now that's just on fire. Like, wake up, people. You've got to, if this is homeownership is something you want, it's not like our parents.
Yeah.
It's
so true.
You have to plan, you have to commit, and it is a process. And once you're in, you're in the club. There is
a targeted group sector that believes that millennials, I make the cut. Us millennials don't want to be homeowners. We just want to rent our piece and have everything taken care of for us and just pay our rent because we don't want to be stuck somewhere, tied down. And that is so wrong. But yet I saw this interview, I think it was on 2020 or Dateline or one of them, that's talking about investors building communities, beautiful homes,
no joke.
And they're only for rent.
They're all rentals.
I
find that mind-boggling.
Yeah.
Entire subdivisions.
Yeah.
It's nuts.
And as crazy as it sounds, they wouldn't do it if it wasn't happening.
There you go.
And it just speaks volumes to the mindset that I guess enough millennials, enough Gen Zers are doing that is now a thing. Well, I mean, you couldn't do that 20 years ago, 15. No. There's no way somebody would have taken that risk.
Be a homeowner back then.
Yes.
I mean, it was an absolute badge of honor for our parents to say we're homeowners.
Yep.
Like, and they wore it with pride, as they well should have.
Right.
And nowadays it's complete opposite almost.
But when you look at who's pushing that, I love Grant Cardone. But he's one of the biggest apartment purchasers in the world.
So true.
He's going to push rent.
Is he wrong for it? I don't think so. I think he's not taking advantage. I call it capitalizing on what is there.
100%.
Others can't. He can.
One of his talks, he said, poor people will always be poor. And that's what he, has made money off of. Because when you're in that rent cycle, you aren't growing equity. And I know it's like beating your head against the wall trying to tell people that, but people don't understand the power of equity and what you can use with it. You can leverage it. You could pay for college. You can, buy other houses with. There's so many things you can do with it. But they're taking that away from us. They're taking it away from the average person to grow wealth and be able to retire. It's like, and I'm not a conspiracist, but
no. I'm a conspiracist.
Yeah.
There wouldn't be conspiracy if there wasn't actual conspiracies. It wouldn't be a thing. But there's two things that you said there that I wanted to hone in on. The first, I'll probably end up forgetting the second, but the first is I think just about every company that sells something, that sells a product, a service, is gearing their marketing, everything towards the poor. Why? Because they are the most frivolous with their money, one, which keeps them poor, as we would say. We don't know what define poor.
Right.
Right. But at the same time, it's like, Are they wrong for doing that? Because they're continuing to buy.
It's a business opportunity.
Right.
That's just unfortunately what it is.
But you look at your companies that don't, your Mercedes, your upper echelon products. They haven't changed their products. They very rarely do any kind of marketing, that kind of stuff, because that they're selling to somebody that takes care of their stuff, or hopefully takes care of their things, that value money, value their time, which is why it's all about convenience and things of that nature. Whereas the other things, it's all about just marketing the next ploy, the next imagery that is for the moment, the next hot topic. That's what they're going to use to push, because that's what the poor consume. Does that make sense? Yeah. I figured I would forget the second thing, and I did.
Well, and if you're a millennial and you don't want to be tied down, guess what? You can rent your house out.
Yes.
So I just feel like I am such a believer in homeownership. I see the wealth that it's built us.
Right. Same here.
And
right.
I'm just like, if you truly want to have a chance in this economy, in this world, it's real estate, guys. It's real estate. Get with Mark, talk to him, figure out a plan, buy real estate.
It truly is the ticket. And I've said this before, I don't think it was on a podcast, but the way to wealth is real estate these days. I think, you know how they have wealth classes and things of that nature. I think that should be redefined, whether you're a homeowner or not, versus rich or poor.
That's a good
true.
one.
You see what I'm saying there?
Yeah.
Because
That's a damn good
at
one.
the end of the day, let's say our parents that were able to get and buy real estate and hold it, that now became a generational wealth that trickled down and trickled down and trickled down. The next relative or the next person in that chain is also going to go and buy real estate because they saw what this benefit did to them.
You hit the nail on the head. So Ernest, one of our clients, he's a nurse in California, and we've been working with him for, I guess, almost 5 years, to see what this gentleman has built on his nurse, California, mind you, salary is mind-blowing. And, yes, they've built specs here that we've sold, but then he goes off and he'll build, a duplex or a fourplex. And I mean, he has learned how to leverage his money, and I'm so proud of him. And what you just said, though, is what just transpired 2 days ago. His son, 23 years old, just sold his first flip through us as well. Why? Because he saw dad doing it.
Right.
And so what do you think that's going to do? Now he's all excited to get the next one.
That's right.
You literally hit the nail on the head. So he saw the example and he's following suit.
Right.
So on the flip side of that, though, one of our clients, an attorney who inherited many, many, many houses, rent houses from his grandfather, who had them for forever.
Sure.
Let's just say. One day he told me he's had 4 generations of the same family in one of their houses. And why is that? Because they saw what mom and dad did.
So meanwhile, those renters that they have in there, you can also see that they will trade those down from relative to relative in some cases, because that's all they know.
That's all they know.
That's tough. How do we do it? We educate. We do what we can.
Exactly.
But I can tell you, no matter how much money you make in your profession, in your craft, if you're not putting it somewhere, and I don't really trust the stock market because it is volatile and I'm here long term. Real estate has been good to me. I mean, You put your money in real estate, as long as you hold it long enough, you're going to be just fine.
Right. You're going to be just fine.
Meanwhile, we're talking about higher rates. Consumers are going, but rates are high. We're talking about low inventory, but I can't find the right house. Well, why not compromise? Why not find a way versus an excuse? Because I've got investors all day long still trying to find ways, even at 9, 10, 12%, and still capitalizing. They're going, okay, yes, I'll pay this higher interest rate now, but as soon as they come back down, I'll refi. So give me a 1-year prepayment penalty.
Right.
No problem. That makes sense. You guys understand the concept of owning that property and generating the income from it, and also keeping the equity growing.
Right. And tax benefits and all the other things. Exactly.
That you don't know until you know.
Right.
Yeah. Man, this has been good.
I always love these talks with you, man. You get the paint.
Let's see. Is there anything else that you guys want to educate the listeners on? Anything that you want to give them that's relevant to what's going on? Anything that you guys got going on? By all means, this is your moment.
You know, I think now more than ever, the consumer, whether they're a buyer or seller, they really need to make sure that they vet who they're hiring, that they vet that person, and that they are that consummate professional and knowledge broker, like she said, and that's who they're hiring, because we are going into a different time. You know, I'm going to say it again. Right now is a time of skill set. That is just what I know to be true. It's not even like I'm guessing. No, I know this to be true. So what are your thoughts?
For me, I would say, I think this COVID taught me so much about community and real estate and what it means. I've never seen money, like seeing $2 trillion pumped into our economy. And some of this money was so easy. I come from a hardworking background with hardworking parents, and I know the value of a dollar. And I feel sad because so many people don't know the value of a dollar, because some of it was just given
easy come, easy go.
Or earned through, you know, some of these
credits,
crypto, whatever.
Yes.
And so I think getting back to just our hardcore American values, getting back to community. Yeah. What a home and a community can bring to a family, and raising good people to, you know, get back to some of our American roots is what I'm hoping and praying for.
I really like that. I think with my closing message and the key factor of this episode, in addition to the market expertise that we saw, the true opinions, and not just opinions, but opinions based off of data, based off of experience, I can say that the biggest key factor is, like Robert said, make sure that you're working with an expert. You look at all the things that we buy, all the places we go as consumers. Don't you look at reviews first? Why not look at reviews or seek out reviews or references and things of that nature for somebody that's going to help you buy the biggest transaction you've ever purchased in your life? I think the information's out there, but we're probably being a little lazy about it. I think on the professional side of things, lenders, realtors, if you don't have reviews, if you don't have references, I'd start working on that pretty quickly. Because that is the way that our market is going. Most of the consumers out there are finding us online first anyway. I think you have to stay relevant with what's going on. And when I say relevant, I mean on a daily basis, because our market is changing that quickly. And there's always opportunity from us to learn from others. If you're open to sharing, you've got to be confident enough in what you're doing, in your business model, in your work ethic, to be able to openly share with other professionals what's going on. If not, you've only got your own perspective. And I think that is a tough part of being a real estate professional, is being open to getting other perspectives, because you may not always be right. So that being said, guys, this is going to be the first episode that we're kicking off on this season. I think it's going to be an excellent episode. If you have not already, go back and listen to the previous season. There's some great content in there that is not necessarily relevant to the time, but more so timeless. But as always, thanks for listening. Thanks for tuning in, and we'll catch you on the next one.
You were talking about money, right?
Separate yourself widely from the pack moving forward. That's something that you would be willing to have a discussion about.
Because they didn't get it. They were
probably
like, hey,
didn't get it. Yeah.
To follow up with your clients, to generate more leads. You know what I mean?
Always check to make sure you're recording.
The record.
Yeah.
Clap, and I need to start over and all that jazz.
Oh,